Good afternoon to all of you. This is again Ranjan from Smart Finance. And this is our website smartfinancing.com. And we are into the academic as well as the software services of the financial market. So we develop various trend analysis software. Also, we have unique courses on futures and options, WD GAN and other things. So if you visit our website smartfinancing.com, you can explore all the products of ours. So in this particular video, I am going to take the theta neutral option strategy. Normally theta neutral, when we initiate, we used to keep some positive theta or negative theta to manage the delta risk or theta risk. However, I will be explaining this thing with the zero theta format. So we will be keeping a theta neutral with zero theta. View the video till the end. If you like this video, give a like and share with your friends. I will be explaining it with one Bitcoin's option strategy example. Similar things you can do with any other segment wherever options are active. So the process will be same, but your approach will be different. So theta is the time value decay the option will go through every day. That is the meaning of theta. So whenever we say theta, so you'll say that time value component of that option, which is supposed to get eroded or which is supposed to be get decayed in that particular day, it is known as theta. So for example, if I am just going for any strike of 30th May Bitcoin and I am going for something called 94,000 put option, and if I click here, it is having a delta theta. So theta, it is telling that it is having a theta of 77. So it is currently quoting at $3,646. So that is for 1,000 lots for one Bitcoin value. So which is 94,218, one Bitcoin value. So for that 3,647 USD is trading. So it is OTM. So out of money because it doesn't have any intrinsic value. The spot is above 94. So this is the theta, $77 per day. So this is saying that end of the day, so it is a 24-hour market. However, by the 12 p.m. night of today, it should decay $77. So the theta should decay $77. That is what it is meaning. But again, it depends upon the IV, it depends upon many other factors. It may reduce lesser than 77, it may reduce more than 77. So that IV will be determining that. But to understand what is theta, you must say that if this option is at 3643, tomorrow, same time at 3 o'clock 28 minutes, if the BTC is trading at 94,228, I will get this same option at a price lesser by 77 USD. That is one meaning, literature meaning. Or the premium should be decayed by $77 by midnight of today. That is what the theta meaning is. So here theta is a decaying factor. So it damages the strategy. If you have any hedge, it gives you lesser return. So these are the things for which we require a theta neutral approach. But many different ways you can form theta neutral approach. And this video I am going to give you the zero theta formation approach. It's a simple thing, But only thing is that you need to understand in depth how you can implement. So this is just a foundation you can think to understand theta neutral strategy. This is one of the foundation video you can see. So three different heads we will be discussing this thing: requirement, adjustment, delta risk or theta risk. Before going to this thing, I have one small announcement. If you have not opened any crypto futures and option account, see the description box. I have given the referral link of mine wherein you can open your crypto fund account. So being our referral client, you will enjoy a lot of benefit from us. Not only in the academic front, you will get a great support to initiate the positions. But for that, once you open the account, you need to establish a contact with us. Simply opening the account, I cannot know what is your requirement, how much you want to trade and all. So if you have already opened or going to open, in that case, after opening the account, activating your account, be in touch with us so that I can help you to set up your trades based on your objective and capital. Fine. These three heads we will be discussing this thing. So first is requirement. What we require? We require to sell an option of near expiry or option having lesser life to expire. So we need one near expiry. So an expiry of 20 days, 15 days, 8 days. This kind of an option we will sell. And we need to buy an option of far expiry, means having a bigger life to expiry, maybe 30 days. So here 30 days expiry if you are buying, 20 days expiry will sell. So here 15 days, if you are 15 days till expiry, it has a life of 15 days, then we should buy one option of 20 days or 25 days. So the buying side options will having bigger life than the selling side option, and preferably the buying option should have ITM option, in the money option. So this is our requirement. This requirement, then we have to form an adjustment, and then delta risk and theta risk I will be discussing. So fine, I will go to the strategy. So normally future having 0 theta theoretically. However, if the future has a premium, then premium divided by the number of days till expiry is the theta of the future. Theoretically, the theta of future is 0. However, if the future is having 1 month expiry and it is trading at a premium of 150 points, then future also have a theta, that 150 divided by 30. So that many people used to ignore. Future also have a theta. So here, just I am adding here. So I am adding one future here. I am buying the Bitcoin future. So this is perpetual contract. It has no expiry. But if you are doing in other markets, you will have the expiries. So here I am just buying one future. So here I bought the future. Now I have to, my aim or goal is to make it as a theta neutral strategy. So what I have to do, I required 30th May is here. I have required the longest expiry. So till 27th June I have the expiry. So I am going to 27th June and I am going slightly in the money. So now it is 94,200. So if I go for 95,000 or 96,000, it will be good. So let me go for 95,000 put. So 95,000 put is having a theta of 56.81. So this is what the theta of 95,000 put having a expiry 27th June. So 57 USD it should decay. So this is what I am adding. So I am just again going to the strategy builder. I am adding a put option of 95,000 and longer dated options I have taken. So offer is 6,442. I am also buying at that 57. Do remember our theta is 57 points for 57 units negative. So this much of theta, $57 every day we are going to lose. So this is in the money. It is having almost 800 points or $800 as the intrinsic. Remaining all are the theta or time value, and $57 decay it is happening per day. Now I am going to one more strike in the lower expiry, which is 30th May, because this is longest expiry. I need to hunt for a call option to sell, so which can give me the similar theta similar. Say if I go for 98, so let me see the theta 80. I don't want 80, I want 57. So if I go for 1,76,000, if I go for say 1,04,000, so what will happen? 62. So 57, 62 almost matches. So here I will be going for a sell of call option of 30th May expiry at 1121 or 73 anything. So which will give me a theta of similar 62 points. So I am losing 57 points of theta here. However, 62 points of the theta I will be gaining here. So by this process, almost I neutralize the theta. But delta will be there, other values will be there, that is different. So if I go here and I can see the Greeks, I will be saying that my theta is almost 62 point here, 56 point I am sacrificing, 62 point I am gaining, so I am at a positive theta of 5 points or $5. I can also make it to as a 0. So here one more thing you have to remember very carefully here. What is the thing you have to remember here very carefully? The strategy what we have and we are entering here, the strategy what we are entering here, so ignore the delta part, ignore the gamma part, ignore the vega part, only the theta part is there, and one theta is 62.3 which we are receiving, another theta what we are sacrificing or giving is 56.81, this we are losing every day. So when it goes for the payoff, because we have bought the future, if the future is going up, then it will give us the profit. 95,000 put options will be losing the intrinsic as well as time value. However, the 1,04,000 strike call option also will be increasing, but we are more concerned about theta. We are not concerned about any other factor. We have just landed with a 5 point or $5 positive theta. So this is what we have initiated. But note these two figures you have to remember. 62.3, 56.81 at the time of your formation, not afterwards, because this theta will change tomorrow. After 1 hour also it will change. So when you are forming this value you have to remember, or the highest value out of that. So here it is 62.3 is highest value, because this is required for our adjustment. So what is the adjustment? So while initiating, the theta was near 0. So 5 points was here. So it was near 0. Now this theta expand or contract by 50% of the absolute value of the largest theta. That is why I told you to remember the largest value. So now largest value is 62. So if the price goes up, theta will change. Price fall down, theta will change. Mostly when the price fall down, theta will change to the negative side. Why negative side? Because the option here 95k put option what you have bought, put option what you have bought for the future, it will become deep in the money and theta component will be more. This 56 will go to 66, 76, 86 like this way. It will go on increasing and this will reduce. So negative value will increase, positive value will reduce. So that theta will go to negative side. So when it is going up, so theta will become positive. Now it is 5 point positive. It will become 6 point positive, 7 point positive like this way. It will increase. So the setup what you have seen, the setup what I have shown here for your example sake or for your understanding, you are having a future buy, you are having a put option purchase, and you are having a call option sell. Put option purchase is the longest available expiry and the call option sell is the shortest available expiry. Monthly option, both are monthly option. So this is what we have done. Now, this particular thing we have understood that 62.3 the theta at the time of our initiation, this is the highest absolute value. Absolute value means positive value. So if the price goes up, the positiveness of the theta will increase. Theta positiveness will increase. If the price, underlying asset price fall or BTC price fall, then this theta's negative nature also will increase. Negative will increase. So this is the conclusion of this formation. This particular formation, other formations will have many other variables for your understanding this thing. So where we should form the adjustment? So if the price is going up, this theta's positive nature is changing and 50% of this thing, the positive which is now positive plus 5 now, the moment it goes to positive 31, 50% of this value. So 50 divided by 100. Divided by 100. So you can say it is 31.15. So if it is 31.15 positive, the moment the theta is becoming plus 31.15, that particular time, close both the options. What you have to close? Future will be already in profit. So what you have to do? Both the options will be at a loss. Price is going up, so these two options will be at a loss. However, the same loss will be compensated by the future. So at that time, both the options, the 95k put option as well as the 1.04k or 1,04,000 strike call option, both you have to close and you have to take a higher strike put, say 97 or 98. Still, that will be in the money at that time. So one in the money put you have to buy, one OTM call you have to sell, and again make the theta to 0 or plus 5. If the price fall and it is coming to negative minus 31.5, so this value is very important, you have to keep on record. So 31.5, then your both the options will be at a profit, future will be at a loss. So if the price falls, future will be at a loss, but this sell or call option, buy a put option at a profit. So you have to book profit in those two put options and call option, sell and put option buy, and you have to buy again the new strike put option, preferably ITM of put option you have to buy, and one OTM call option you have to sell in such a way that it should make your theta 0. So this process will continue till you are having or holding this strategy. But what is the risk it involves? That is very important. It has two risks. One delta risk as well as theta risk. Whenever you form Theta zero strategies, you have two risks, delta risk, theta risk. Delta risk will trigger if the intrinsic value you paid for buying the option is less than the recovery cost. Theta risk will trigger if the volatility goes up substantially post you initiate the position. So here, what happens here in this particular case? In this particular case, we are selling one option. We are selling one option at say 1121. But the intrinsic value in this option is if 94 180 we are taking, then almost intrinsic value in this put option is near to 800 rupees. $800, not rupees. USD. We are receiving 1121, so we have lesser delta risk or positive delta risk. However, if it is having an intrinsic value of 1200 and you are receiving 1100, it is absolutely at delta risk. That will land you in losses. So what is the theta risk? After you initiate the position, the IV which is currently at 38%, 39%, if it goes to 50%, then the theta risk also will. So it has some complexities and that has a solution for that complexities also. So those complexities having some solutions also. Solution doesn't require that you must add some another 2-3 legs or you should add any extra size to it. With this, by changing or tweaking the strikes, you can find out the solution for that. For your basic understanding, theta neutral or theta zero formation requirement is one option which is having lesser life to expire, another option which is having more life to expire. So the lesser life option should be sold, more life option to be bought, and futures should be stopped in between. If you want to form it only with the option, then some other strategies you have to make it. Maybe a long triangle with a short straddle, similar kind of formation also you can make it. Long will be having in the June series and short will be having in the May series. That also you can do. But all this theta neutral will go through these two risks, delta risk and theta risk. Delta risk triggers if your sell value does not cover the intrinsic value of your buying house, not the time value, intrinsic value of your buying house. Theta risk triggers if volatility goes up suddenly post you initiate the position. So this is just a foundation, and more on the futures and options you can find out from our courses. So which is having a 40 hours of course on options, but slowly you have to go, steadily you have to read through that. Number of examples are being given, similar things you can implement in your strategies. But it is a wonderful line, it is a very scientific line, the futures and option trade. If you just understand the fundamentals of it, you can make very good gain or profit in this. Do share this video with your friends, give a like for this video. Those who want to use our referral, please follow the description box. Thank you very much. Thank you for your time.